Hello, hello, hello. This is your boy Ken Akure. Welcome to today's session of training on how to trade and be a profitable trader. To be able to trade and and be profitable, you need to be able to force your mind, your brain, to start thinking in probabilities. Now, as humans, we are not designed to think in probabilities. The way our physiology, our biology, the way we exist, we're not designed to think in probabilities. We are designed to demand certainty. And by that, I mean, you will not buy your phone, the phone that you're using. You will not buy your phone if you knew that the phone had a problem. You won't buy it. Only a fool will buy it. You won't buy it. Why? You want certainty that this phone I'm buying is good, is in perfect condition. That's when you buy it. But that you are buying it doesn't mean that there's still a probability that the phone has an issue that you are not aware of. But as humans, our minds don't want to accept that aspect, that there's always something we don't know. There's always something that can happen that we don't know. There's always a probability that this thing we're doing can be wrong. For example, if you want to put money into a business, let's say those people that invested in a business called Rockstally, it was a Ponzi scheme that crashed recently, and a lot of people lost their money. Now, the only reason they invested was because they had some form of certainty in their mind. They convinced themselves in their mind that this money they are putting into this business will come out. If at any point they didn't have that feeling of certainty, they will not put in that money. But because nobody does business to lose, nobody wants to do an investment that fails. Nobody. That's why somebody can take all the money that he has 5 million naira is all the money he has. He takes all that 5 million and puts into Rockstally. If he knew that Rockstally will crash, he will never put his 5 million into Rockstally. But his mind cannot perceive that probability that this thing can crash this month. Some people know, oh, it's going to crash eventually. But their mind cannot open to see that, oh, it can crash next month or next week when my money is inside. As a trader, until you start thinking in probabilities, you will not succeed long term. Why? If you're thinking in probabilities and you have a leverage of, you have a collateral or account balance of $360, for example, and you are using 20x, meaning you can open a trade size of 7,200. Now, you will not be thinking in probabilities if you now go and enter one trade at once with all your full margin of 7,200. Because to do that, it means you're not thinking, what if this trade is wrong? What if this trade is a losing trade? Does it mean I just lose all the 7,000, sorry, all my collateral, $360, just by taking one trade? Then somebody will be like, yes, the trade can also be a winning trade. We know it can be a winning trade, but there's still a probability that it can be a losing trade. So since you're not sure which of them will play out, because as a trader, you know that you have winning trades and you have losing trades. You don't know in what sequence the winning trades will come. You don't know in what sequence the losing trades will come. If you have identified an edge, a trading strategy that you're using, the next thing you now need to force your mind to start doing is how to think in probabilities. And one way to help you think in probabilities is to trade in sample sizes. Like I told you guys to do, trade in sample sizes of 20. So if you have $1,000, for example, uh, you're going to say, I'm dividing this $1,000 into 20 parts, meaning on each trade that I'm taking, I'm only risking $50. So for me to lose my entire $1,000, I have to have 20 losing trades. And except your village people are strongly on your case, it is impossible to lose 20 trades in a row following a fixed strategy, no matter how bad that strategy is. Even if you're trading just support and resistance, you cannot lose 20 trades in a row without winning a single trade. It is almost impossible. The same way, it is almost impossible to win 20 trades. It's possible, but the probability is low to win 20 straight, at a go. No, now, so since you know the limitation that you can have winning trades, you can have losing trades, you now split your account balance into position sizes that can that shows that you're thinking in probabilities. Okay, I have 20 bullets in in my uh, my gun. Instead of shooting all the 20 bullets at one target, I can take out one target as a sniper, wait for another opportunity, shoot again like that until I exhaust the 20 bullets. Then I look at my account balance, then split it up again into 20 trades, into 20 again, and go again for another sample of 20 trades. Now let's look at this slide. Now, to think in probabilities, you need to have to create a mental framework or a mindset that is consistent with the underlying principles of a probabilistic environment. A probabilistic mindset pertaining to trading consists of 5 fundamental truths. Now, these 5 fundamental truths reinforces the fact that your technical analysis or your fundamental analysis does not control the market, and you can never know for sure exactly how the market will move next. Meaning that chart that you saw, there's no probability that because you sold, then price will start going down. There's nothing like that. There's no such probability that the market will always do what you want it to do. No. So you now have to start thinking that, okay, what of times where my trading strategy fails? And to do that, you need to understand the 5 fundamental truths about the nature of trading or about the nature of the market. So let's say you're trading Ethereum, for example, and you're trading on futures. The first thing you need to realize is that anything can happen in the market. Anything. It means that you can put your $360 on 20x, use full margin of 7,200, take a trade, and it will be a winning trade. Why? Anything can happen. Anything can also happen that you can put that 7,200 and you will lose it. Why? Anything can happen. So the question is, if you know that anything can happen, will you go in trading? Meaning anything can happen in the positive, anything can happen in the negative. If you know that you can lose money on this trade, will you go and sell your father's house and come and use it to put in futures or to put in trading? No. To do that means you are thinking that only what you want will happen. You're thinking that I only have winning trades. Do you understand? You not go and carry money that you need for your feeding or that you need for your house rent and come and put in trading. You won't do that. Why? You are thinking, what if I make loss? Or what if this particular trade I'm entering is a loss? Or let's not even go too far. You have $3,360 in your collateral. Will it make sense to risk the entire $360 knowing that this particular trade can be a losing trade? No, you won't do that. The next one is, You don't need to know what is going to happen next in order for you to make money in the market. Now, you don't need to know, because if you start thinking you know what will happen, then it will stop you from acting the way you should act in the market. Let me share my screen again. We'll come back to this. Okay. Let's look at this trade, for example. If you guys can see this, let's look at this trade, for example. I don't need to know that I don't need to know if my strategy will work now. Remember, this is our strategy. I don't need to know if this strategy will work now if I enter this trade. I don't know. So what do? I follow the rules. I don't need to know if the rules will work in this particular trade now that I'm entering now. I don't know. So to think that I know what will happen, I'll be hesitant, because you might be thinking, oh, if I enter now, it will be a losing trade. So you start experiencing what? The fear of losing. And the fear of losing will stop you from taking trades. Then some people, instead of checking their confirmation checklist or following their trading rules, they now jump and just enter a trade. Why? They are afraid that if I don't enter this trade, market will go and leave me. So they are suffering from the fear of missing out. So the fear of missing out causes them to abandon their rules and jump into the market. Do you understand? Let's continue. So let me go back to this. Now, the second one says that, okay, the second one says you don't need to know what is going to happen next. So why don't you need to know? The only thing you need to know is the trading strategy that I'm following. Is it present in the market or is it absent? If it's present, you take the trade, you put your stop loss and you walk away. You are expecting only two outcomes. Either it hits my profit, take profit, or it hits my stop loss. That's it. Then the third one is there's a random distribution between wins and losers and losses rather for any given set of variables that define an edge. Now, this is what this is referring to. Now, these are my set of variables. These three criteria that I have is price at resistance, is price coming from an area of support, is TDI. These are my variables for buy and sell. Now, for each of these variables that I follow, they give me my trading edge. Now, though, if I follow these variables religiously, follow my trading edge, I will have winning trades and I'll have losing trades. And they come randomly. I don't know which set will be the winners first or the losers first or how they will come. They happen randomly. So that's what this point is saying, that there's a random distribution of wins and losses for your trading strategy, meaning no trading strategy, no matter how good, will give you 20 winning trades. It can happen, but it's very rare. Then no trading strategy, no matter how bad, will give you 20 losing trades in a row. It will always be a random distribution, meaning you have, let's say, one win, let's say one win, one win, one win. Then you have, okay, no, let's do it this way. Let's say you have 20 trades, right? Then you have winners, you have losers. Let's say you have one win, you have loss. Let's say you have one win, you have loss, loss, loss. Then you have win, loss. Then you have win, 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 win. This is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Do you understand? Let's say you have another win 12, win 13, win 14, win 15, win 17. Then you have loss, loss, loss. So this is 1, 2, 3, 4, 5, 6, 7. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Let's have another win. Win. So in 20 trades, you have 1, 2, 3, 4, 5, 6, 7. In 20 trades, you have 13 wins and 7 losses. So overall, you are a winner. So this is telling you that this exam number 3 is telling you that there will be a random distribution. The distribution can come in any sequence. So long as you are following your trading strategy religiously, you have this random distribution. Then number 4 says that your edge, meaning your trading strategy, is nothing more than an indication of a higher probability of one thing happening over another. What is saying that your trading strategy does not tell you exactly what the market will do. It only indicates that anytime, let me share my screen again, anytime your strategy is present in the market, anytime your strategy is present like that, like, okay, this is your strategy. If price is at a resistance, is below your market baseline, TDI is oversold, like you have here, sell. So it doesn't tell you that every time you see this and you sell, that a sell will happen. It only tells you that most times there's a higher probability that based on this strategy, this market will sell instead of going up. So based on that, you are sticking to your edge. It doesn't mean that your strategy or your edge will work 100% all the time. Now let's continue. So we've dealt with number 4. Then number 5 says every moment in the market is unique. Every moment is unique. No two moments are alike. Now, let me also explain from the chart. What it means by every moment is unique is that, for example, for this thing to come down, there are sellers that sold. For it to go up, there are buyers that bought. So if price, okay, price was at this support and went up. Now price is at around the support. Will it go up or will it stay here? Now that it went up here in this moment doesn't mean that it will also go up here. Why? This moment here is unique from this moment. It might look the same because it's at the same level of support, but they are not the same. Today was 24th. Today is 27th. Different days. The pattern look the same. It doesn't mean that it must play out like it played out before. Do you understand? So that's what it means by every moment is unique. And if you know that every moment is unique, then you won't approach this moment the way you approach it. You won't expect exactly the same thing from here. So that's why if you know that every moment is unique, you will not go and risk all your moments, all your money in your account on this trade right now, just because before when market was here, it went up. So you're saying that, oh, before, because it went up before, then here it must went up. So therefore, let me put all my money here so that it will go up and I can go and buy a Lamborghini. No, if you're doing that, then you don't understand that this moment is unique from the previous moment. Do you understand? Every moment is unique. Now, those are the 5 fundamental truths about the nature of the market. So the purpose of knowing these truths is so that it will sink in your head, not to overtrade, not to over leverage, not to over risk. Why? Anything can happen. If anything can happen, why should you overtrade or over leverage? If you don't know what is going to happen next for you to make money as a trader, why should you be afraid of entering a trade just because your last trade was a losing trade? There's no need. That's number 2. There's no need. You don't need to be afraid because the last trade was a losing trade. Therefore, this trade will be a losing trade. You don't need that fear. Why? Because you don't need to know what is going to happen next. You just follow your strategy. All right. So after understanding the 5 fundamental truths about the nature of trading, The next thing you need to now start understanding is the 7 principles for consistency. Now, these are affirmations. These are things you say to yourself until it enters your brain. It enters your consciousness. It removes every indiscipline and stupidity out of your trading career. It helps you to focus on the long term. It helps you to follow the trading rules that you've written for yourself. And the first one is, I am a consistently profitable trader because, number one, I objectively identify my edge. It means when I'm looking at the market, when I'm looking at the charts, I don't look at it with any bias, with any carryover emotions. I look at, I check my confirmation checklist and say, okay, if I want to sell, I go over my rules. Is price at resistance? Is price below my market baseline? Is the RSI in oversold? Why? I want to use objectivity. I don't want to be thinking, oh, is our support? Oh, is that this? No, I don't want to be bringing in random variables into my trade. I want to follow the rules I've set. So that's what it means by I objectively identify my edge. The key word there is objectively, not subjectively. Subjectively is subject to change. Objectively, you are looking at it clearly and it's either that thing is there or is not there. Number two, I predefine the risk of each trade. This is so important, guys. I hear people trade and they say they don't put stop loss. And the reason they give for not putting stop loss is because anytime they put stop loss, market to come and hit the stop loss and still go in their favor. So they stop putting stop loss. I'm like, even though you don't put a hard stop loss, you should put what is called a mental stop loss. And I explained this in the other videos on technical analysis that have been on the group before. Now, you need to identify, predefine your risk. So when I was showing you guys on FTX that if you have $1,000 account, if you have, if you want to risk $50, you open a position size of $1,000, then your stop loss is at $50. So that tells you that this is the risk. You have predefined this risk that no matter what happens on this trade, I'm only going to lose $50. So this is what number two means. I predefine the risk of every trade. And for every trade you're entering, you must know how much you will lose in case you are wrong. You must know before you press the button, sell or buy, you must know. If you don't know, you are gambling and you don't want to be a gambler, trust me. You need to know what you're doing. That's the only way to build confidence. Number three is I completely accept the risk or I'm willing to let the trade go. Meaning for me to enter that $50 trade, it means I'm prepared to lose this $50. If you are prepared to lose it, sometimes we enter a trade, it's going in our favor or it's going against us, the market start pulling back. It means that then we close the trade with a loss. Even then, instead of the market hitting our stop loss, we enter a trade here, we put our stop loss here. But instead of the market coming down, the market, instead of it coming down, it first of all starts going up. Even though the trade signal is still there, it has not been validated, we now get out of fear. Instead of allowing it to hit this $50, we now get out. So instead of the trade hitting stop loss, it now reverses and goes to hit our take profit. So to avoid this from happening to you, any trade you enter, you must accept that this $50 that is this stop loss is not my own again. Let it go and hit it. The only time, in fact, you don't change. As a beginner, you don't change. For someone that maybe is advanced like me, I go say, oh, I didn't get that entry well. Let me get out with this small loss. But for you that are coming up, just stick to the rules. If it goes to hit your stop loss, fine. You wait for the next trade. Then number four, I act on my edges without reservation or hesitation. Meaning, if I see my trading strategy, I don't hesitate. Once I check my rules, number one, price at resistance. Number two, price is below my market baseline. Number three, RSI is oversold, conditions are met. I don't think, what if it's losing trade? Oh, what if Bitcoin does that? Oh, what if this happen? If you are beginning to do all that, you are hesitating. And if you hesitate, you won't build confidence in yourself as a trader. So you want to accept the consequence of every action of yours. So you follow the rules so that you know, oh, I followed these rules, but it was a losing trade. It wasn't my fault. Market did what it did. So you have confidence. Then you won't hesitate. You won't have reservations. Number five says, I pay myself as the market makes money available to me. Why do you pay yourself? Why? Let me share my screen. You pay yourself because you don't know how far the market will go in your favor, and you don't know at what point the market will get to, then start reversing. You don't know at what point that will happen. So what do? You trade in uh, in fractions or in different position sizes. So that's why if you notice, when I call a signal, I always drop TP1, TP2. Why? For example, see this drop down. This was a long move. Market just kept going. So this is massive profit. But on your own, you think, oh, market will get here. Market will get here, form a support and reverse. Okay, let me share screen. Okay, sorry about that. I'm sure you can see my screen now. So I'm saying that that number five says, I pay myself as the market makes money available to me. What it's saying in essence is that you don't know how far the market will go in your favor. So when the market starts going in your favor, be taking profit gradually. I know people that bought Bitcoin at $10,000. It went up to $60,000. They didn't take any profit. Now it has retraced to $30,000. Imagine if they took some profit at $60,000. They will still be in profit overall. Even now, they are still in profit, but then that profit they took, they can use it to buy more. So what I question is that number five is saying is that, let's say, for example, it says I take profit as the market makes money available to me. It must be in your rule. So let's say I sell here because our trading plan said we could sell. Why? Unveiled indicators, everything is below, everything measures up. So this is a sell. So if I sell, this is the first obvious level. I put my take profit one here, TP1. Market breaks, retest it, create another sell opportunity. I won't add. I will not add. I entered here with three positions with different take profits. So market comes here, TP1 is closed. Market comes back down here, TP1 is closed here, market worms and comes to retest it. I adjust my stop loss from somewhere here to somewhere here. This is a risk-free trade now. Market come down this way. Maybe my TP2 was somewhere around here. TP2 is closed. Market reverses. I adjust this, my stop loss that was here now. I bring it here. I now hold on to this stop loss. I now hold the final TP and see how far market will go. If market come here and I see this reversal candle here, this one, I can close. Why? Because sometimes market might just keep going in your favor, and you don't want to that, oh, you sold, you sold here, but then you got out of the market, you got out everything here. So all this move that the market did, you didn't find a good entry opportunity, so you missed out on all this move. But if you now start thinking the way of a trader, you always have TP1, TP2, TP3. Why? Because you don't know how far this market will keep going, and you want to do it such that if the market keeps going in your favor, you keep milking the market and making profit. Then number six says, I continually monitor my susceptibility or vulnerability to making errors. It means that you have to keep checking. Oh, I made this error. Oh, this was an error. Let me correct myself. This was an error. Let me correct myself. You know, you want to be doing that. Why? Like I said, and anytime you make an error, you correct yourself. For example, sometimes you want to enter a position size of $300. Then you mistakenly go and type in $3,000, and maybe the trade goes through because you are using 20x leverage, so you have a lot of leverage. So you immediately notice, this is $3,000 I entered. Oh, no, 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 no. You correct yourself immediately. You get out of this position or reduce, close 2,700 and leave it at 300. Why? It's an error. But some people, when they make this error, they now hold it and say, oh, let's see, it's already going against me. Let me see if it will reverse. No, it was a mistake. Get out immediately. That's what it calls to making errors. Then sometimes you might be tempted to say, oh, let me not put stop loss. And you actually enter, immediately you remember, say, what am I doing? Go back and put stop loss. Then sometimes you enter a trade not following your strategy as strictly and religiously as you should. Immediately you realize that you jumped, and this thing still happens to me. I won't lie, I'm not a perfect trader. It happens most times when I wake up early in the morning, I'm still in my bed. So instead of me getting up and sitting by my trading decks, and clearing my head, going for making sure my mind is free, I now just say, oh, let me look at what the chart is doing. Most likely, most times I do it from my phone. Oh, I saw a signal on my phone. Let me enter. Meanwhile, if I had gotten up and gone to my laptop, I'll see a bigger view. And that is because I personally don't like trading on the phone. You know why? Because I'm always with my phone and I don't want to be looking at chat all the time. So I can't be looking at chat from the laptop, then go to the phone and, so I make that error. But anytime I make the error, I don't stay in it. I correct myself. Why? I am not perfect. I'm acting on number 6. I correct my errors. When I notice I've made an error, I correct it instantly. If it's not instant, immediately I realize, I write it down. Oh, I made this mistake. Then number 7 says, I understand the absolute necessity of these principles of consistent success, and therefore I aspire never to violate them. Meaning you will not violate number 1 to 6. Meaning before you enter a trade, you have to identify your edges. Number 2, you need to predefine your risk. Number 3, you need to accept that risk that you've entered. Number 4, you need to act on your edge without hesitation or reservation. Then it's saying that you are respecting all of this. You are respecting all of this and consciously following through. So this is, by the time you start doing this, making this confession, now I'm going to give you guys this. You need to type it out. Type it on your phone. Write it in your book. Say these things to yourself every day. I'll give you another affirmation. Wake up in the morning, say, today I'm a great trader. I'm going to make money from the market. I'm powered up. I'm pumped up. I'm a winning trader. I was born to do this. I was born to win in the market. I'm like a lion in the jungle going after my prey. I'm going to win. I'm like a giant, taking charge in the market. I'm flowing with the market. I'm swimming with the waves of the market. I'm a winning trader. I'm a disciplined trader. I make money today. I have the mind of a trader. I have the mental toughness to follow my rules. You're talking to yourself like this. Why? Trading is of the mind, guys. It's of the mind. The technical analysis is not enough. You need to pump yourself up and tell yourself, I'm following my trading plan today. I'm going to accept the risk of every trade. If the trade ends up being a losing trade, I don't care. I'm going to live to trade another day. I completely accept the risk of every trade that I put. Why? Because I know I don't control the market. And if the market gives me a profit or a loss, I will not go down frowning or depressed or anything, because I didn't risk all my accounts. Therefore, I have enough money to enter more trades as I see more opportunities that will be winning trades. And act on my strategy without being afraid or hesitating or rationalizing. I pay myself as the market goes in my favor, meaning I don't become greedy. I don't become greedy today. As the market gives me profit, I take some, I allow market to move again, I take some. I don't hold on to a trade and keep wishing it will keep going in my favor. No, that's to trade as a greedy trader. I don't do that. I trade as an excellent trader. I continue monitor myself so that I don't make errors. If I notice any error, I correct myself. Why? I'm a winning trader. This is the way winning traders think. This is the way winning traders behave. They pump themselves up. Positive pep talk. When you go outside and someone is bashing trader that you are trading, you are gambling, you quieten those voices. You don't want to listen to those people. Why? This is a path that you've chosen, and you're going to win on this path. You are a warrior in this race, and you win. You're like a gladiator on the scene, annihilating the enemy. The enemy in your trading is distraction. Distraction from any source, distraction from things happening in your life. You are quietening those voices. The enemy is the voice of fear, telling you that you'll never be a successful trader, telling you that you'll never make money from trading. That is an enemy. You're saying, no, not for me. I'm going to win in this game. You talk yourself like that. At least, if you can't do it every day, do it at least twice a week, 3 times a week. You meditate, you're pumped up, you're fired up. Why? Why? You want things to happen. Why? You're taking charge of your mind and ensuring that you are disciplined. you know Thank you guys for joining this class. I'm going to see you again in the next one.